All right, you've tuned in because you're curious about SCHD, right? Thinking about adding it to your portfolio this October. Well, you've come to the right place. We're going deep on its potential, checking out its past performance, those sweet dividends, the stock split everyone's talking about, and what the experts are saying.
SCHD's definitely got people buzzing in the investment world, so let's unpack it.
To kick things off, let's rewind the clock a bit. SCHD first hit the scene back in 2011. How has it done since then? Give us the rundown on its track record.
Well, since it launched, SCHD has racked up a total return of 169.14%. Basically, if you had invested back then, your money would have almost tripled. Now, remember, past performance isn't a crystal ball, but it does show that SCHD's got some staying power, especially considering the market's had its fair share of roller coaster moments.
Almost triple, huh?
Yeah.
Not too shabby. But let's get to the good stuff, those dividends, the cash that lands in your pocket. What kind of growth are we talking about here?
This is where SCHD really flexes its muscles. Over the past decade, its dividend has shot up by a whopping 124%, averaging about 8.4% growth each year. And get this, that growth beats inflation, which is huge for making sure your money keeps its buying power. Right now, it has a tasty yield of 3.7%, a pretty tempting figure for income investors.
Yeah, that kind of steady growth is definitely attractive. Speaking of attractive, let's chat about this stock split. It's coming up soon, right? What's the deal, and what does it mean for someone who might want to invest?
You got it. Mark your calendars for October 11th. SCHD is doing a 3-for-1 split. Now, keep in mind, this doesn't actually change the fundamental value of the ETF. It's like slicing a pizza into more pieces, right? You get the same amount of pizza, just in smaller slices.
So same pizza, just easier to grab a slice.
Got it. Exactly. And you know what? That often gets investors excited. A lower share price can boost liquidity, making it easier to buy and sell. Plus, it can attract new investors who might have thought the previous price was a bit steep.
Psychology plays a big role, that's for sure. Let's say you took the plunge and invested in SCHD back in 2014. Your dividend payout per share would jump from $1.05 to $2.66 in 2022. That, my friends, is the magic of compounding. But what about the future? I've seen projections tossing around a 7% yield by 2034. Is that realistic, or should we take it with a grain of salt?
It's always good to be optimistic, but with those kinds of projections, it's important to keep your feet on the ground a little bit. Those numbers are often based on models and assumptions. In this case, they're assuming an average growth rate of 8%. While SCHD has a strong history of growth, some analysts think the pace might ease up a bit going forward, maybe landing somewhere around 8–9% per year. Part of that has to do with the current interest rate situation, which can affect dividend growth.
So we've seen SCHD's shiny resume, but like with any investment, there are always two sides to every coin, right?
Yeah.
What about the potential downsides, the things that might make someone tap the brakes?
You're absolutely right. Every investment has its own quirks and considerations. It all comes down to matching those up with your own goals and your risk tolerance.
Okay, so what are some of those things that might give potential investors pause? What are the speed bumps on this road?
Well, one thing that's hard to ignore is the current market climate. We're seeing some pretty high valuations across the board.
High valuations, meaning things might be a bit overpriced right now.
Yeah, there's that concern. The KPE ratio, which gives us a long-term view of market valuations, it's currently sitting at 35.5.
And that's ringing some alarm bells.
It's definitely raising eyebrows among analysts. A potential market correction is something to keep in mind. It's not a sure thing, but it could impact even the most solid ETFs like SCHD.
So even the best dancers can trip if the dance floor gets bumpy.
Exactly. Another thing to consider is how SCHD has been performing lately compared to the broader market. It's been lagging a bit behind.
Ah, so maybe a chance to buy low, as they say.
Some investors might see it that way, but it's important to dig deeper and figure out why that lag exists. Is it a temporary blip, or are there deeper reasons behind it?
Right, got to separate the signal from the noise.
Exactly. And lastly, let's not forget the golden rule of investing: diversification.
Ah, yes, don't put all your eggs in one basket.
Even if that basket is full of dividends, right? SCHD might be a star player in a dividend-focused portfolio, but it shouldn't be the only player on the field. Spreading your risk and building a well-rounded strategy is key.
Makes sense. So we've talked about some potential drawbacks, the what-ifs. But let's switch gears for a sec and focus on what makes SCHD so appealing in the first place.
Great point. There's a reason this ETF is turning heads. One of its biggest strengths is its focus on large-cap value stocks. We're talking about established, often blue-chip companies with a long history of paying out dividends consistently.
The reliable old guard of the market.
Exactly. These companies tend to be more resilient, more likely to weather economic storms compared to their younger, more volatile counterparts.
So a bit more stability, especially in uncertain times. What else makes these large-cap, consistent dividend payers stand out?
Well, SCHD specifically hones in on companies with strong fundamentals and healthy cash flow. They're not just paying out dividends for the fun of it, they have the financial strength to back it up.
Because no one wants a dividend check that bounces.
Yeah.
So we've got stability, consistent income. Anything else investors should know?
Oh, absolutely. Let's not forget about fees. SCHD has a very low expense ratio, just 0.06%. That means more money stays in your pocket.
Every penny counts, as
Yeah.
they say, especially when it comes to long-term compounding. And SCHD has an interesting track record there. I've heard that since it debuted, investments have essentially doubled every 5, 6 years. That's pretty impressive.
Yeah, that's the power of steady dividend growth combined with the magic of compounding. Of course, past performance isn't a guarantee, but it does give you a sense of SCHD's potential for growth over the long haul.
Okay, so we've covered a lot of ground here. We've looked at the potential downsides, the upsides, and those impressive returns. Now, let's see how SCHD measures up against the competition in the vast world of ETFs. All right, let's kick things off with the big kahuna in the room, the S&P 500. The benchmark everyone's always comparing things to. How does SCHD's dividend yield stack up against the broader market?
Great question to start us off. So right now, SCHD is sitting pretty with a dividend yield of about 3.48%. Now, if you compare that to the S&P 500, which usually comes in around 1.22% for SPY, a popular ETF that tracks the index, well, you can see SCHD's focus on those dividend-paying companies really paying off.
Yeah, a definite win for SCHD in the yield department. But the ETF world is always evolving. Are there any other contenders out there, other dividend-focused ETFs, giving SCHD a run for its money?
Oh, absolutely. It's a competitive landscape. While SCHD has been impressing everyone with its dividend growth, I will say 2023 saw a bit of a slowdown.
Oh, really?
Yeah, growth came in at 3.77%. However, even with that little dip, its 5-year dividend growth rate is still a very respectable 12.9%. Just to put that into perspective, that beats out competitors like HDV, which is sitting at a 4.5% growth rate over the same period.
Okay, so maybe a slight stumble, but still holding its own against the competition.
Yeah.
What about their consistency over time? Because that's a big one for dividend investors, right?
Absolutely. Consistency is key, and that's where SCHD really shines. They have this incredible track record of increasing their dividend payout for 12 years straight. Now, some analysts are projecting that future growth might settle somewhere around 8-9% annually, still very respectable, but that history of consistent increases, that can be really reassuring for income-focused investors.
Definitely. That peace of mind is valuable. Okay, so we've covered a lot of ground here. We've looked at the numbers, the pros, the cons, the competition. What's the bottom line for someone listening who's thinking, should I hit that buy button on SCHD come October?
All right, here's the deal. SCHD has a lot going for it, especially if you're looking for dividend income and the potential for long-term growth. It has a strong track record, low fees, and it focuses on companies that have weathered some serious market storms. And this is a big, but no investment is risk-free, right? You always have to weigh your options, do your homework, make sure it aligns with your financial goals, your risk tolerance, all of that.
Couldn't agree more. Do your due diligence, understand the risks, and make sure it fits into your overall investment strategy. Here's a little food for thought as you're doing your research. What if SCHD continues to beat the market when it comes to dividend growth, but lags behind in terms of price appreciation? How would that affect your long-term strategy? Something to ponder. Thanks for joining us for another deep dive. Until next time, happy investing.